In this video, we're going to break down the 4 most common types of stock market orders. And why are we doing this? Well, because it can get real complicated when all you're trying to do is just buy a stock. Because these brokerages, in an effort to help you, they've made a bunch of different order types. You might be telling them, hey, just buy Apple. And they're throwing all these options back at you. Do you want to buy it like this, or this? We got a market order, a limit order, a stop loss, a stop limit. We got algorithmic orders. We got good to cancel orders, after hour orders, all these different types of orders. It's too much because what you always want to do in the stock market is simplify as much as you can. More simple usually equals more money. So that's why we're going to break down the 4 most common types of orders that you need, and you don't need more than this to be successful, I'm telling you. Now, will just knowing these orders alone make you rich? No, of course not. I wish it would, but it doesn't. That's like saying just because you know what the stock market is that all of a sudden you'll become rich. I mean, obviously no. There's a few more steps, but this stuff is important to know because, again, you put it together with other things that you learn about how to invest in the stock market, and you will make more money. These orders in particular, in addition to making you more money, they also just make your life a lot easier. Because basically, what are all these special order types that they throw at you? They are automations. So again, they're supposed to make your life easier if you understand them. And that's why we're going to break them down in this video. And don't feel bad if you don't understand them or if you need to look them up multiple times. I myself still look them up, and I've been doing this for years. Because you need a quick reminder. Too many of them. And the best way to look them up is on Investopedia. A lot of people don't use this site, and I'm not sure why. But if you go into Google and type in, say, a market order, Investopedia is going to be the first thing on the list. And it's real quick. It takes you 2 seconds to look up what you're doing before you do it, which is important in the stock market to know what you're doing so you don't lose money. Because people forget, yes, you can actually lose money in the stock market. But if you're watching this video, then you're already using your head and thinking, hey, I got to know this stuff before I continue. So the 4 order types that we're going to go over today, and these are really all that you need. In fact, one of them you probably don't even need, but we'll go over it anyway. But the 4 types are market order, limit order, stop loss, and stop limit. So first up, we got the basic market order. And what is this? Well, if you're placing a market order, you're basically telling your brokerage to buy or sell at the best available price. This is the least picky type of order, the least specific. So say you log into your brokerage and you say, hey, I want to buy a share of Apple. Well, if you enter a market order, then they're going to buy it for you at whatever the market price is, which according to this is $127.35. And that's likely the price you're going to get. So again, market order, right? So whatever the price is in the market at the time of your order. And of course, there is a little lag because it's not instantaneous. Even though everything is electronic now, the brokerage still has to purchase that share for you. So there can be a very, very small lag. So if on your screen Apple says $127.35, the actual price you buy it at might be $127.37 or $127.30. It might be somewhere around that price because of the lag time between when you put the order in and when they actually purchase it for you. And you know markets are moving constantly up and down, lightning speed, so things can happen. And that's actually one of the drawbacks of a market order. Now, if you're investing in a large stock like Apple that's huge, you're not going to have much risk if you put in a market order. If you see the price at $127.35 and you put in a market order to buy it at that price, you're probably going to get it at that price. Because look at this thing, it has over 50 million shares traded per day. It's huge. It's actually closer to 100 million per day. So that is what we call liquidity. Tons of shares going back and forth, so the prices are more stable. Now, the same thing doesn't happen when you move into other stocks, especially smaller stocks. One of the worst areas to put in a market order are when you're playing with penny stocks, which by the way, you shouldn't be playing with in the first place, but those are fluctuating like crazy and they don't have many shares traded. So you might put in an order to buy at $3 and by the time you get it, it's at $4. It can be a mess. And it doesn't even have to be a penny stock. Lately, meme stocks are popular and you could see how crazy some of the action has been in AMC. If you're putting in a market order, you don't really know what price you're going to get because it's swinging so fast during the day. So once again, that could be dangerous because what do you want when you place an order? You want to get what you ask for, right? At the price that you ask for it. So depending on what you're investing or trading in, the market order could be good or bad. Now at Fallible, we have an investment system. We're all about systems here. You'll hear me talk about it all the time. And we basically have an algorithm that ranks stocks by their momentum and we invest in the highest momentum stocks each month. Now, when our model buys these stocks, it will just put in a market order. It will just put in a market order at the market open. So for example, if it was buying Apple, it would buy Apple at whatever price it opens at. It doesn't care. Now again, that could be good or bad. So I'm recording this on a Friday right now. If I put in a market order for Monday when the market opens, this thing could gap up higher or it could gap down lower. You don't know, right? And if you have a market order in there, it's just going to buy it at whatever price it's at. Now the reason we can use these market orders with our system is because we are very long-term investors and we're investing in very liquid stocks. So the actual risk of gaps is not as high. And because we're so long term, it's not going to hurt us either way. Which there's some good advice right here. If you are investing, you should be thinking more long term than shorter term. Because the shorter you make your time frames, like if you're just trying to flip a stock overnight, that's where that price where you get in is really going to matter. Versus if you're longer term, I can just put a market order in and not worry about it. So if you want to make your life easier, extend your time frame, make it more long term. And again, that's why we can use market orders in our system, and there you go, it's automated. I could put a trade in Friday and not even wake up in the morning. I could wake up as late as I want, and I'm still going to get filled on my order. Don't even have to log into my account or anything. That's the point of these orders, to make it easier. Now, if you want to buy something but you want a little bit more control over the price, that's where you move to a limit order. Now, a limit order, and once again, we're using Investopedia, which you can use if you ever forget this. This lets you purchase or sell a stock at a specified price or better. So again, all these orders, they can be buy or sell orders, right? So for a buy limit order, the order will be executed only at the limit price or a lower one. So say I want to buy something at $10. It won't buy it for anything above $10 because again, stock prices are moving all the time, right? So I'll buy at $10, $9, $8, no problem. $11, not going to buy. Same thing goes for sell limit orders. The order will only be executed at the limit price or a higher one. So if you want to sell at $10, then it's only going to sell at 10, 11, 12, or 13 because in that sense, you're just going to make more money. You don't mind if it's going above your sell price. So with these limit orders, you could basically cut off one side. You basically get your price or a better one, depending if you're buying or selling. So see how that differs from a market order, because a market order will get you in at any price. It doesn't matter. So here's an example. Say a trader is looking to buy a stock, but has a limit of $14.50. So they're only going to buy that stock at $14.50 or lower. Same thing if they're looking to sell that stock at $14.50 limit, then they will not sell any shares until the price is at $14.50 or higher. So with this type of order, you're always making sure that you get what you want or better. So there's a few different times when you would use a limit order. One is when a stock is rising or falling very quickly, and you're afraid that you're going to get a bad fill. So in those more liquid stocks that we're talking about that are constantly going like this, or like an AMC, you want to make sure that you're protected and getting the actual price that you want, of it just gapping and screwing up and you buying at a price you didn't want it at. Another good time to use a limit order is if you don't want to watch a stock. If you have a specific price in mind that you want to buy or sell at, you could just put that limit order in the market and let it sit there. So it can be left open with no expiration date. So say I buy a stock at $5 and I say I definitely want to sell when it hits $10, but I don't want to sit there watching it every day. Well, you could put a limit sell order at $10 and that thing will automatically execute and get you out. And again, that's exactly what we do with our Fallible system to help automate the whole thing. We have something called price targets. So if a stock moves to a certain price, we want to get out. And by get out, I mean we want to sell some of our shares and take some profits. But again, if we want to automate this thing, what we do is put a sell limit order at a certain price. And when that price triggers, that's when those shares are sold and we take those profits. And it's all automatic. It's very nice. So we just set it and forget it. Here's another example. Say a portfolio manager wants to buy Tesla, but they think it's too high of a price right now. But if it falls, they definitely want to get in. So they say, okay, I want to buy 10,000 shares of Tesla if the price falls below $250. So to do that, they would place an order to buy 10,000 shares with a $250 limit. So if the stock falls below that price, they will automatically start buying into it. And the order will remain open until it's filled, meaning the price reaches where they wanted it to, or they just cancel the order. Again, makes it easier because it's automation. Now the next type of order is a stop loss order. So far we got market order, limit order, and now a stop loss order. So a stop loss order is an order placed with a broker to buy or sell a security when it reaches a certain price. So when a stock falls below a stop price that you set, the order becomes a market order and it executes at the next available price. So here's an example. A trader may buy a stock and then they place a stop loss 10% below the purchase price. So if that stock drops 10%, that stop loss order will activate and the stock would be sold as a market order. So the name stop loss kind of makes sense, right? Because if a stock drops a certain amount, you just want to get out. So say you bought a stock at $10 and you put a stop loss at $8. Well, if the price hits $8, the stop loss will trigger a market order, which means it's going to sell at whatever price the market is offering. And that gets you out real quick because the point is to get out, because this leads into risk management. This is why you use this thing. So again, here's another example. A trader buys 100 shares of a certain stock for $100 and sets a stop loss order at $90. The stock declines over the next few weeks and finally falls below that $90. Well, the trader's stop order gets executed and the position is sold at $89.95. You see that? It's not exactly at $90 because you're not going to get that perfect fill. It's a market order, right? So the closest it could get was $89.95 once it was triggered. So again, why do you do this? Well, you do it to manage your risk. You do it so that you could get out out of a stock before it falls even more. It's like Warren Buffett said, the number one rule in the stock market is not to lose money. And the number two rule is don't forget the first rule. So an order like this can really come in handy. And again, we use these types of orders in our Fallible system. We'll select a certain stop loss level. We'll say, hey, we just bought this stock at say $10. If it drops to $8, we're going to get out. So we just put that order in there and we don't have to watch the market anymore. Makes our lives easier and it protects our risk because if that stock is falling, we want to get out. Now, one negative aspect of a stop loss is if a stock suddenly gaps lower below the stop price. So say you set that stop loss at $8, but this thing gaps from $10 to $5, 50%. Well, guess what? That order is still going to trigger, and instead of selling at $8, you're going to sell at $5. It sucks, yeah, but the point is that you're trying to stop it from going from 5 to 4 to 3 to 2. So if you get out at 5, you'll still be happier than if you try to get out at 0, which at that point, bankrupt. So just like setting limit orders at your target prices, setting stop loss orders at your risk points is also another good strategy. And this all goes into trade management, which, believe it or not, is 90% of successful investing. It's not about picking the best stock. That's only 10% of the game. The other 90% is the stuff that we're talking about right here. How do you manage it? And these order types help you do that. Now, the last type of order we're going to talk about is the stop limit. And this one is a little more complicated. And in fact, you don't even really have to use this one. It's up to you. The benefit of it is that it does give you more precision in what prices you're going to get. So the best way to understand this one is just through an example. And as you can imagine, a stop limit order is combining a stop order with a limit order. So for example, assume that Apple is trading at $170 and an investor wants to buy it once it starts showing some serious upward momentum. So once it starts going up. So the investor decides to put a stop limit order to buy with a stop price of 180 and the limit price at 185. So what he's basically saying is buy this if it goes above 180, but don't buy any if it goes above 185. So if the price of Apple moves above the 180 stop price, the order is activated and it turns into a limit order. And the limit order is for 185, so it can fill it as long as it's under 185. But if the stock gaps above 185, it's not to be filled. So this is basically where you're trying to target a specific price range. For this guy, it's between 180 and 185. And realistically, you know, it could go from 180 back down to 175 and it would still activate. But what he's really managing for is if it keeps going and it shoots past where he wants to buy it, because it might be too expensive for him. So for him, he doesn't want to buy above 185, only below it. So he's trying to capture that $5 range. So you can see combining these two types of orders, the stop and the limit, gives you more precision. But again, you don't necessarily need to do that. You don't need it to be successful. It's up to you. And I always say the more simple you can make your investing, the more successful you're going to be. And the more you can automate it, the more successful you're going to be. So I personally would stick to the market order, the limit order, and the stop loss order. I don't really use stop limits too much, if ever. And again, these order types are an extremely important piece of the total investing picture. And they're actually key for one of the most important things that you need to do in the stock market, which we made a whole video about right here. It is the most important stock market video you'll ever watch and is the key to long-term success. If you don't do what we're talking about in this video, it's going to be tough to grow your wealth year after year or make any money in the stock market whatsoever. So click this video right here and I will see you there.